Before we get into the numbers, I want to do what most channels don't do, which is look back. In late 2023, we said that rising Treasury issuance would push the 10-year yield above 4.5% before stabilizing. It peaked just over 5% and then mean reverted. In early 2024, we argued that gold breaking above $2,100 would likely consolidate rather than go vertical. Gold topped near 2,250, pulled back, and then based. And 6 months ago, we said China reducing Treasury exposure would be gradual, not a sudden liquidation. That part matters today. We won't get everything right, but accountability is part of this process. Now let's talk about the number driving the headlines. The claim is that China has exited roughly $688 billion in U.S. Treasuries at a record loss. The raw data first. China's Treasury holdings peaked around $1.32 trillion back in 2013. As of the most recent Treasury International Capital data, those holdings sit closer to $775 billion. That's a decline of about $545 billion in nominal holdings. When you layer in price effects from rising yields over the last several years, analysts estimate the mark-to-market and realized losses could approach $600 to $700 billion over a decade-long period. Context matters here. This reduction did not happen in 1 year. It happened slowly over more than 10 years across multiple rate cycles. What it means is that China has been diversifying reserves away from long-duration dollar assets. What it does not mean is that China woke up one morning, panic sold treasuries, and declared financial war on the U.S. second data point. China's share of total foreign-held U.S. treasuries. In 2011, China held about 26% of all foreign-owned treasuries. Today, that figure is closer to 11%. Meanwhile, countries like Japan, the UK, and offshore custodial centers have increased their share. The context here is globalization of demand. The U.S. Treasury market has grown massively. Outstanding marketable debt is now over $27 trillion. China's reduction looks dramatic in isolation, but the market itself has more than doubled. What it means is that China's relative influence over the Treasury market has declined. What it doesn't mean is that the Treasury market is somehow unsupported or on the verge of a buyer's strike. Auctions continue to clear, often with strong indirect bidding. Third data point. Where did the money go? China's official reserves are still around $3.2 trillion. Gold reserves have increased steadily from about 1,050 tons a decade ago to roughly 2,260 tons today. That's a significant increase, but gold still represents under 5% total reserves. At the same time, China has increased holdings in other currencies, policy banks, and strategic assets. What this means is diversification, not abandonment. What it doesn't mean is that China has gone all in on gold, or is preparing for a dollar collapse tomorrow morning. So let's talk about the bullish interpretation, because there is one, and it deserves to be stated clearly. First, sustained foreign selling of treasuries puts upward pressure on yields over time. Higher yields increase interest expense for the U.S. government, which already exceeds $1 trillion annually. That's structurally supportive for hard assets like gold and silver. Second, reserve diversification signals declining trust in long-term dollar purchasing power. Even if the dollar remains dominant, marginal flows matter. Precious metals benefit at the margin. Third, China's gold accumulation reinforces the idea that central banks want neutral reserve assets. That's been a multi-year trend, not a one-off event. Fourth, when geopolitics intersect with fiscal stress, volatility increases. Volatility is historically positive for gold, and with a lag, silver. Putting this together, the bullish scenario where this accelerates a broader de-dollarization narrative and lifts precious metals meaningfully has about a 25% probability, in my view. Now the bear case, which is underrepresented in headline coverage. First, China did not sell treasuries into a vacuum. Domestic institutions, pension funds, banks, and other foreign buyers absorbed the supply. The treasury market is still the deepest, most liquid market on earth. Second, much of the loss is mark-to-market, not realized. Rising yields hurt bond prices, but that's true for every holder, not just China. Third, China still holds nearly $800 billion in treasuries. That's not an exit, that's a rebalancing. Fourth, if this were truly destabilizing, we would see it in the dollar. The dollar index remains range-bound, not collapsing. The bear case, where the story fades into the background as another slow-moving reserve shift, carries roughly a 35% probability. That leaves the middle case, which is where I think reality lives. China continues to slowly reduce treasury exposure, not because of panic, but because of long-term strategic allocation. The U.S. continues to issue large amounts of debt. Yields stay structurally higher than the 2010s. And precious metals benefit modestly, but not explosively. No collapse, no moonshot. This middle path sits around a 40% probability. It helps to zoom out historically. In the late 1970s, foreign confidence in U.S. fiscal policy weakened, inflation surged, and gold exploded higher. The similarity is fiscal strain. The difference is credibility. Today, the U.S. still has institutional trust, deep markets, and global demand for dollars in trade and finance. This is not 1979, but it's also not 2012. Cross-market signals matter here. Gold is trading around 20,250, well above its 200-day moving average. That signals long-term confidence hedging, not panic. The dollar index is around 104, not breaking down. That tells you this isn't a dollar crisis. The 10-year yield near 4.3% reflects heavy issuance and term premium, not failed auctions. Together, these markets say stress, but controlled. Positioning supports that view. COT data shows managed money moderately long gold, not at extremes. Banks remain net short as usual, but not aggressively so. Institutions are hedging, not fleeing. So what am I doing with this information? Here's my framework, not advice. If yields spike above 4.75% on the 10-year while gold holds above $2,300, I add to precious metals. If the dollar breaks below 101 decisively, I increase exposure. If yields fall sharply and the dollar strengthens, I trim. Right now, my allocation is roughly 12% gold, 6% silver, 2% miners, 60% diversified equities, and the rest in cash and short-duration bonds. My stop loss on silver is around $27 spot. My take-profit zone is $38 to $40 over the next 12 to 18 months. Not advice, just my framework. What am I not doing? I'm not panic buying metals on geopolitical headlines. I'm not binge-watching fear-based content that assumes collapse. And I'm not assuming China has some master switch that ends the dollar overnight. Here's my watch list for this week. First, the 10-year auction. Weak demand would be bearish bonds, bullish metals. Strong demand does the opposite. Second, dollar index at 103. A key, break lower supports metals. A bounce caps them. Third, gold above $2,400. Acceptance there opens upside. Rejection suggests consolidation. To wrap this up, here's what matters. China reduced Treasury exposure over a decade, not a week. The losses are real, but mostly structural, not tactical. This supports precious metals, but doesn't guarantee a surge. And the most likely outcome is slow, controlled adjustment, not financial collapse. If this kind of calm, data-driven analysis helps you think more clearly, consider subscribing. This is Financial Briefing. Stay sharp.